euro to US dollar pair is really holding its ground this week, with buyers stepping in as we approach some crucial US employment data. It's interesting to see how easing price pressures in the States are putting a bit of weight on the US dollar, right? Meanwhile, the European data isn't exactly painting a rosy picture either, leaving the European Central Bank in a bit of a bind. Despite this, the bullish sentiment for euro to US dollar remains intact in the midterm, but you can feel that hesitation from buyers. It's like they're waiting for the right moment to pounce. So, as we gear up for the employment report, keep an eye on those levels. The market could swing in either direction, and it's all about timing your moves wisely. Let's see how this plays out. The euro to US dollar pair has wrapped up a rather uneventful week, hovering around the 1.1200 mark. It briefly touched a fresh 2024 high of 1.1213 midweek, but once again, sellers stepped in, pushing it back down. This persistent struggle raises concerns about the European economy's progress, or rather, the lack thereof. Meanwhile, speculation is swirling around the U.S. Federal Reserve's potential to maintain its aggressive stance on interest rate cuts. This uncertainty is keeping investors on edge, leading to a cautious trading environment. As we navigate these market dynamics, it's crucial to stay alert and adapt our strategies accordingly. The battle at 1.1200 continues, and it's anyone's guess where we go from here. The euro to US dollar pair has been caught in a tug-of-war this week, with the euro struggling to gain traction despite a weaker US dollar. European macroeconomic data has been underwhelming, particularly the September HCOB flash PMIs, which came in below expectations. The composite PMI dropped to 47.2, marking a fourth consecutive month of decline. This signals a troubling trend for the Eurozone, with the German economy sinking deeper into contraction. As Forex traders, we need to tread carefully. The market's volatility could present both risks and opportunities, but the current economic landscape suggests that any euro gains might be short-lived. Keep a close eye on these indicators, they could dictate our next moves. The latest manufacturing index has shrunk to 40.3, a concerning signal for investors. Meanwhile, services output is barely clinging to expansion, slipping from 51.2 to 50.6. The EU composite PMI has also dropped to 48.9, falling short of the expected 50.6. This decline is particularly alarming in the manufacturing sector, which is now facing its first output contraction in 7 months. New orders are decreasing at the sharpest rate since January, raising red flags about future growth. With these trends, we must seriously consider the implications for our investments. The economic landscape is shifting, and we need to stay vigilant. The latest German IFO survey on business climate has dropped to 85.4 in September from 86.6, signaling a concerning shift in both expectations and current assessments. This decline is raising alarms about the potential for a recession, prompting speculation that the European Central Bank may need to continue cutting interest rates to stabilize the economy. Meanwhile, across the Atlantic, the situation isn't much brighter. The S&P Global PMIs reveal a contraction in manufacturing output for September, although the services sector remains resilient with a strong index at 55.4. These developments highlight a critical moment for business professionals. We must stay vigilant and agile as we navigate these turbulent economic waters. The stakes are high, and the decisions we make today could shape the future of our industries. The recent drop in the Conference Board's Consumer Confidence Index to 98.7 in September is raising some eyebrows. Just last month, it stood at 105.6, a significant shift that signals potential trouble ahead. The Present Situation Index took a notable hit, plummeting by 10.3 points to 124.3, while the Expectations Index fell by 4.6 points to 81.7. This is particularly concerning, as readings below 80 often hint at an impending recession. With this backdrop, it's no surprise that market participants are adjusting their strategies, now betting on a possible 50 basis point cut in interest rates from the Fed come November. As investors and traders, we need to tread carefully. These indicators suggest a cautious approach is warranted, as the economic landscape may be shifting beneath our feet. Staying informed and agile will be key in navigating these uncertain waters. By the end of the week, we saw some encouraging signs from the U.S. economy. The Q2 gross domestic product came in at a solid 3%, right on target with previous estimates. That's a reassuring indicator of economic resilience. Durable goods orders held steady in August, defying expectations of a 2.6% decline. This stability suggests that businesses are still investing, which is a positive signal for growth. And then there's the Personal Consumption Expenditures Price Index, the Fed's go-to measure for inflation. It rose by 2.2% year-over-year in August, just shy of the 2.3% forecast. While it's slightly below expectations, it still reflects a manageable inflation rate, which is good news for consumers and investors alike. Overall, these figures paint a picture of an economy that's navigating challenges with a degree of strength and optimism. The latest data on the PCE price index is quite encouraging. We saw a monthly increase of 0.1%, right in line with what analysts predicted. The core PCE price index, while rising 2.7% year-over-year, also matched expectations with a monthly growth of 0.1%. Although that's slightly below what some anticipated, it still reflects stability in the economy. Even more promising is the boost in consumer confidence. The University of Michigan's Consumer Sentiment Index climbed to 70.1 in September, up from 67.9 in August, surpassing the market expectation of 69.3. This uptick suggests that consumers are feeling more optimistic about their financial situations, which is a positive sign for spending and economic growth. For investors and traders, these indicators point to a resilient economy, making it a great time to stay engaged and informed. Sentiment is definitely on the rise, and it's exciting to see consumers' expectations for the economy brightening. As we look ahead to next week, all eyes will be on Europe, particularly Germany and the Eurozone, as they release their preliminary estimates for September's Harmonized Index of Consumer Prices. This data could provide crucial insights into inflation trends and consumer behavior. Then, midweek, we'll shift our focus to the U.S. employment data. Strong employment figures could further bolster investor confidence and signal a robust economic recovery. With these developments, we're witnessing a potential turning point that could lead to new opportunities in the market. It's a thrilling time to be an investor, and I'm eager to see how these indicators shape our economic landscape. The ADP employment report is set to drop, revealing how many private jobs were created in September. This is crucial for us as investors and traders because it sets the stage for the non-farm payrolls report coming this Friday, which is a major indicator of the overall labor market. A strong jobs report could signal the Fed's next move on interest rates, impacting everything from stocks to bonds. But that's not all on the horizon. We'll also see the ISM Manufacturing PMI and Services PMI for September. These figures provide insight into economic health and can sway market sentiment. Keep your eyes peeled. The data we receive this week could shape our trading strategies for the months ahead. Stay sharp. By the end of this week, we're poised to gain valuable insights into the American economy, and that's crucial for our investment strategies. The euro to US dollar pair is showing promising signs. The technical outlook suggests that the risk skews to the upside. We've seen a higher high and a higher low, indicating that buyers are firmly in control. Plus, it's trading above all its moving averages, which is a strong bullish signal. This momentum could present us with great opportunities. As market participants digest the upcoming economic data, let's stay alert and ready to position ourselves wisely. The market is ripe for those willing to seize the moment. The 20 and 100 simple moving averages are trending upwards, hovering just below the 1.0900 mark, while the 200 SMA presents a mildly bearish dynamic support around 1.1040. This setup indicates a cautious optimism for euro to US dollar. However, we must note that technical indicators are still well above their midlines, yet they're showing signs of losing upward momentum. They're consolidating near overbought levels, but there's no clear indication of upward exhaustion just yet. For traders, the daily chart suggests that while there's potential for further gains, a decisive break above the 1.1200 mark is essential for confirming any bullish continuation. Keep a close eye on these levels, they will be crucial in guiding our next moves. Observing the current market dynamics, the 20 SMA is exhibiting a bullish grind higher around the 1.1100 level, acting as a reliable dynamic support. Meanwhile, the 100 SMA continues its ascent, comfortably positioned above a flat 200 SMA, which indicates a strong upward momentum. This alignment suggests that buyers are firmly in control. The momentum indicator is also reflecting this bullish sentiment, aiming north and well above the 100 level, signaling robust buying interest. However, the relative strength index, consolidating around 59, raises a caution flag. While it indicates strength, it hasn't yet confirmed a full-blown bullish run. Traders should remain vigilant. The technical landscape is favorable, but confirmation from the RSI will be crucial before making any significant moves. The euro to US dollar pair is at a critical juncture. If we see the 1.1100 level give way, support could materialize around 1.1050. This could open the door for a potential drop towards the 1.1000 mark. It's essential to keep an eye on these levels, as they could dictate the pair's next moves. On the flip side, if we manage a clear break above 1.1200, we might see a rally towards 1.1240, and possibly even 1.1300. Longer term, there's a target of 1.1470 that traders should consider. Staying alert and ready for these shifts is crucial in this volatile market.
Thanks for tuning in to Global News04, your source for all the latest news across every area. Don't forget to like, share, and subscribe to our YouTube channel. Stay tuned, and make sure to turn on all notifications to stay up to date with the latest global news. Check out our other videos for more in-depth coverage, and follow us on social media to never miss a beat. If you'd like to support our work, scan the QR code to make a contribution. See you next time.